I'm CPA Ned Lenhart, and I'm the president of Interstate Tax Strategies. My firm specializes in providing multi-state companies with sales and use tax advisory services. Our mission is to help multi-state companies reduce their risk and increase their long-term profitability and value by proactively managing this complicated area of state taxation. In this video, I outline what I believe are the top 3 sales tax risks facing most multi-state businesses today. When I say risk, I mean the actual financial cost to your business if you make a mistake. These mistakes can require your business to pay back taxes, interest, penalties, and professional fees. Sales tax mistakes, if left uncorrected, can pose catastrophic consequences to your business. The following 3 errors are the ones I believe pose the biggest risk and financial cost to multi-state businesses. Businesses that have a firm understanding of these areas and invest the time needed to keep them current have a much lower exposure than businesses that don't. Nexus is the linchpin to all forms of multi-state taxation. States generally cannot compel tax compliance responsibility from non-resident businesses unless that business has nexus with their particular state. Once nexus is created in the other state, then that state can use its full legal force to compel the business to legally comply with their state tax rules. This can mean prospective tax compliance as well as historical assessment in some situations. A complete discussion on nexus could consume hours of video, but for this video, I'm going to keep it very simple. For sales tax purposes, the U.S. Supreme Court requires there be some significant physical presence in the foreign state before nexus is created in that state. For most businesses, the following activities will create nexus in another state: having employees soliciting sales in the state, performing any type of service in the state, either directly or by a third party under your control, having independent sales reps or other agents in the state representing your company, owning or renting personal property in the other state, or delivering property into a state in a vehicle owned by your company. Just because your business has nexus in the state doesn't automatically mean that you have some type of sales tax collection obligation. What having nexus in a state means is that your business must take a deeper analysis of your business activities in that state to determine your actual tax obligation. The best time to do this analysis is before you get contacted for an audit. Once you're contacted for an audit, there may be no time to conduct the careful analysis needed to assess your risk. The second risk faced by most businesses is caused by missing or invalid documentation to support any exempt sales transaction. Wholesalers face special challenges when it comes to sales tax compliance. Even though they may not have the obligation to collect tax from their customers, they must still follow the rules in the states where they have nexus concerning the documentation required to support any non-taxed sale. All sales of property are deemed taxable unless your customer provides the documentation required to support the exemption they claim. If you are audited, your failure to have the documentation can create a large financial risk for your company. While many states may allow companies to get exemption certificates after the fact, if your customers are out of business, it's going to be impossible to get those certificates. Failure to have the documentation to support your non-taxed sales could make all your sales taxable under audit. Exemption certificate management becomes more complex when third-party drop shipments are involved. In this situation, your company will be required to provide a resale certificate to your supplier that is valid in the state where the delivery occurs, and you will be required to obtain a certificate from your customer in the delivery state. To minimize this second risk, you must be proactive in obtaining valid documentation at the time of the sale. The third area putting multi-state companies at risk is the use of incorrect tax rules being applied to the goods and services they sell. Hundreds of changes occur each year. Some changes are legislative and are well published, but other changes come from court cases, rulings, and regulations which may go unnoticed. Many of these sales tax changes are subtle and may pose little risk to your business. Other changes can be significant and create a material financial risk for your company if you are not updating your sales tax rules properly. Even if you use an automated sales tax decision system, you may still need to do a review of this system to make sure that the rules are customized to fit your products and your invoicing methods. If your business has not had its sales tax decision rules verified in the past year, then you run the risk of undercharging your customers' tax, which puts you at risk in an audit. The best time to analyze your exposure to these three risks is now, before you're contacted by a state for an audit. After you're contacted, there is little opportunity to properly address these issues. If you have any questions about the three multi-state sales tax risks I've mentioned, or would like assistance evaluating your company's multi-state risk, please feel free to contact me for a no-cost, no-obligation 30-minute discussion. Please contact me through my website, salestaxstrategies.com. Thanks for watching and have a great day.